Welcome back. We have some fresh economic data that has allowed the GBP CAD pair to slide to its lowest level in almost a month. Will this be the new normal for the pair going forward? In this video, we will discuss the recent price action and the latest fundamental developments that will likely drive the GBP CAD pair in the short term. As always, if you appreciate content like this, please hit the like button and consider subscribing. The GBP CAD pair has been under significant downward pressure in recent weeks. After the UK's new Chancellor of the Exchequer, Kwasi Kwarteng, announced his growth revolution plan with the aim of boosting the UK economy. However, instead of calming markets, the plan only added to the sell-off in the UK government bonds, which is why the Bank of England was forced to intervene and buy gilts to stop the rout. Even though the intervention has been successful so far, the damage to the currency has already been done. At the time of recording, GBP CAD is at its lowest level in almost a month. It is trading at 1.5670, down more than 3% in the last 7 days. The selling pressure on the pound intensified after the UK's new Prime Minister Rishi Sunak unveiled his new government's economic plan, which includes tax cuts and spending increases. This comes at a time when the UK's state coffers are far from brimming with cash. As such, the UK's borrowing requirement will increase, which will put additional pressure on the government to print more money. And you guessed it right, more money printing means more inflation. But we are getting ahead of ourselves. Back to Sunak's new economic plan. While the growth revolution sounds great in theory, the reality is that the UK economy is in sharp decline. The country's GDP fell by 0.3% in August, much worse than the 0.1% drop that economists were expecting. As such, the economic plan is unlikely to get support from those who think that now is not the time for tax cuts and spending increases. The plan also lacks specifics, and it is mostly focused on long-term supply-side reforms, which won't help an economy that is facing a long and severe recession brought on by high energy prices. On the other hand, the Canadian dollar is finding support from the latest PMI data, which showed that the country's manufacturing and services sectors are still holding up well. The manufacturing PMI came in at 56.9 in September, above the 50 level that separates expansion from contraction. While the services PMI declined to 55.2 from 56.9 in August, it remains above the 50 level. The strong PMI suggests that the Bank of Canada could continue with its rate hikes when the next policy meeting takes place in October. In the short term, we expect the GBP CAD pair to remain under pressure as the Bank of England is expected to start cutting rates in early 2023, while the Bank of Canada is expected to keep hiking rates until at least the second half of 2023. A recession in the UK and resilient growth in Canada will also contribute to the pair's decline. Our bearish target for 2022 remains unchanged at 150. Only a sharp deterioration in global risk sentiment could send the pair lower. Thank you for watching. If you enjoyed the video, please leave a like and consider subscribing. We would greatly appreciate your support.